Tanvi Gupta of UBS India, Jaideep Iyer of RBL Bank both join in with their quick reactions on the much anticipated RBI policy meet. Jaideep, I'll start with you. Largely in line with what we were expecting, no significant changes in stance, no rate action, obviously. Interesting that the governor did mention that global concerns have changed and they are significant. But what did you make of it?
No, I think as you mentioned in your summary, I think fairly in line with what the market expectations have been. I think the RBI over the last many months have been very, very clear in how they want the markets to perceive their thinking, and therefore they wanted to kind of continuously make the point that it's going to take some time before they change their mind on either the monetary policy stance or the rate. And therefore that was pretty much in line. I think the broad, if I have to kind of also take a view from a banking standpoint, broadly, I think the Reserve Bank of India is essentially saying that times are good for India. There is a fair amount of economic stability, reasonably good growth, and therefore we should continue to kind of take tough decisions on all fronts so that we don't have pockets of froth building and therefore sustainable growth. I think the message is quite clear that we are not looking for short-term bursts of growth, but we would rather have steady growth over a longish period of time. So I think that's how they're looking at it, and it's rightly so.
Okay, Tanvi, what is your initial assessment? Some reference to Q1 growth, maybe revised slightly lower, but otherwise sanguine on growth and using that as the main clutch to say that, hey, we're not doing anything with rates.
So very much, I think it is on expected lines. I would say slightly with a hawkish touch, not really dovish, not really neutrals, mostly continuation of what they have been reiterating. I think the June quarter growth is expected to be slightly lesser than what they have been forecasting because of the heat wave conditions, and we have elections. A lot of capital spending or capex spending didn't happen during the June quarter. The government spending was mostly focused on election. Plus, the data was also the high-frequency data, which we track, which is our UBS India Composite Economic Indicator, shows the momentum was positive. But specifically in the month of June, we did see a slowdown in the momentum, even though it was still positive. I think what is clearly coming out from the policy is that the RBI is not comfortable with this credit-deposit mismatch. They are very comfortable. They are clearly highlighting that the growth is strong. Inflation seems to be on expected lines, 4.5% inflation. In fact, there was a section of the market who were expecting that maybe they will tweak the GDP growth numbers after the economic survey came out with an expectation of 6.5, 7, but they kind of maintained. So, lowered the June quarter GDP, but kind of, offset it by the other 3 quarters GDP growth, which is slightly higher. But I think what is interesting is that what is their take on the credit? So they are not comfortable with credit flowing into other sections of the societies, largely in the unsecured loan category or the equity home loan, which might be going into speculative purposes. And I think that is very interesting because credit has been a big positive for India's economic growth. But since FY23, the credit growth has consistently outpaced the deposit growth, and it's looked like the RBI is now getting more and more cautious of the fact, and there will be more measures coming up. How do you streamline the credit and the deposit growth?
Absolutely. And Tanvi, that's really the big question, because the RBI governor follows on by saying that banks need to find innovative ways to attract household savings. In fact, let me come to Jaideep Iyer with that question. Jaideep, great to speak with you. What are these innovative ways that you can mobilize household savings, and especially if those savings are going into asset classes which over the last 2 or 3 years, let's say equities or equity allied, have been giving great returns?
Yeah, so I think one clarification on this point from my side. Buying equities by us is not really going to impact deposit growth as such, because when somebody buys, somebody sells, so the money is in the system. However, I think what it does mean is that the household savings is getting probably less channelized into bank deposits. And I think part of the reason arguably has been that there has been a boom in terms of markets for a while. We've seen a lot of significantly large quantum and expansion of a mutual fund industry. I think we are at about 60 lakh crores today vis-a-vis a bank deposit base of about 2.1, 2.2 lakh crore. And I think maybe 5 years back, this was much, much more lopsided in favor of the banking deposits. So I guess, but this trend is going to continue. And I think, from what bankers can do, I think the simplest answer here would be to increase rates. Obviously, that comes at a cost of margins or at the cost of being able to lend at higher rates. But honestly, I think it's going to be a little bit of impact on the growth of credit as well. I think there is less that banks can do on garnering household deposits, but more that they can do on slowing down credit growth. So I guess somewhere, the balance could be coming from also slowing down credit growth, which in my judgment will have some level of impact on growth down the line.
I don't know if they'd want to slow down credit growth because the growth outlook has seemed positive. Why would you want to turn off one engine down to simmer? I don't know what your view on that is, Tanvi. Could you see some action following what the RBI governor is saying today?
I would say definitely I won't expect a sharp slowdown. So, but I would expect the credit growth to continue to grow faster than your nominal GDP because that's how it will be adding to the economic multiplier, not really leading to any drag on growth. So we have been seeing that RBI has been taking steps to rebalance this mismatch. I mean, there has been an increase in regulatory tightening to soften the unsecured loans by banks and NBFC. Interestingly, in the budget, we saw an increase in capital gain tax rate on other financial products, including equities. I mean, that should, on a relative basis, enhance the attractiveness of bank deposit versus other financial products. I think the very interesting point which I have been noting is that in the last 1 week, the system liquidity has turned into surplus. So this has actually helping in the overnight operative rate, which is a call money rate, actually trading 30 basis points below the repo rate. And I think that's a double whammy which the banks were facing when there was a massive credit deposit mismatch at one end and a tight system liquidity during the months of September 23 and Feb 24. I think that is also kind of will help in giving some kind of relief to the banks. But yes, I would we are more of the view that the bank credit growth is likely to soften towards 13% by end of March 2025. Right now the number is around 14, so we are seeing some rebalancing but not a very sharp slowdown.
Jaideep, sorry, I saw you wanted to reply to that. Just maybe make a quick point there.
No, I mean, I think, if you look at while the LCR guidelines are still draft and it's going to take some time before it becomes a policy. But if you look at the general direction of what the RBI has been doing, they've increased risk weights on certain categories of lending. Today, there was a mention of the fact that be cautious on top-up loans, don't be aggressive on lending. So I think the messaging is quite clear that, be conservative here. Do not chase growth for the sake of growth. So I would expect, I'm also not suggesting a dramatic reduction in credit growth, but clearly on the margin, all the verbal and the policy measures that the Reserve Bank of India has been taking, including some in the pipeline, will mean that there will be ultimately the deposit and credit growth has to converge at some point in time, and that will be through a combination of both some rate increases from banks to garner more deposits and some reduction in lending overall.
We also have with us Jayesh Mehta, Head of Strategy at DSP Finance. Hi Jayesh, thanks for joining in. The policy was largely on expected lines, no surprises on most fronts. But tell me, we are not setting ourselves up for a rate cut at this stage. What do you think will it take for the RBI to move on rate action? Because we don't have an economy that's deteriorating. Neither do we have inflation that's moved so disinflationary that rates need to be cut. Because when the Fed moves in September, we will have some pressure to act a few months after that, right? Would that be the only reason you think? Would that be a reason good enough for for the RBI to move when it does?
So I think, as you saw also, there were two members wanting a rate cut, right? And there are people talking about a rate cut because even right now, assuming global instability was not there, or we had some data on the major it would have been very different.
Jayesh, I think we're struggling with your audio, so we'll come back to you in a minute. Tanvi, you want to comment on that? We're not setting a stage for a rate cut anytime soon. I think Jayesh is back. Jayesh, you want to complete what you were telling us?
Yeah, so basically what I'm trying to say is like there is a case for rate cut even now, but because of global uncertainty and all that, we would wait. And I think October policy would be a stage if US cuts rates, would be a stage for a rate cut. So I would still bet on October rate cut to happen. As you saw today also, there's a 4 versus 2 on keeping the rate the same, whereas 2 proposing rate cut. It is justifiable purely because of the differential and the inflation forecast being 4.4 and your repo rate being 6.5, almost 2%, 2.1% differential. So I think we should see something in October.
As early as October. All right. So that's you know, a view which we've not heard very often. Most are looking at the first rate cut maybe in early 2025.
Jayesh, a quick take from you on the outlook on the 10-year. I mean, you know, for the last few months, parts of the street, very optimistic expectations have come in, but the yields haven't moved significantly. We are in surplus liquidity. The budget, of course, laid out a pretty solid roadmap as well. So the real exchange rate is far better than what it seems. What is your target on the 10-year towards year end? Where do you see it head to?
So till the time we have repo rate at 6.5, I do expect it to go around 6.75 in some time. But if the repo rate changes as I'm thinking in October or December, then basically, with the new repo rate at 6.25, we would be down to maybe 6.55 or 6.50 levels on 10-year. I say the way I look at it is the differential between the repo and the 10-year benchmark, which in expectation for rate cut can narrow down to 10 basis points, which is 6.75. And of course, if you look at demand supply dynamic with your new LCR rule coming, there is additional demand which is coming in over and above the FPI index inclusion. So basically the demand supply dynamic is very skewed towards a little bit of squeeze there, but we do expect some RBI sale or OMO sale to also happen. Otherwise, it becomes difficult to have demand supply mismatch.
Tanvi, what is your assessment for when we'll see a rate cut, possibly? And is that getting tweaked after what you've heard from the governor today?
So after today's policy, I would clearly highlight that RBI is giving much more weight to domestic food inflation dynamics and overall inflation dynamics more than the global factors. Obviously, if there is what we are seeing, if there is easing by the global central banks, global volatility has gone up because of the US hard landing concerns, that will have an impact. But if you look at our forecast, our first rate cut is expected from the Fed policy. We are expecting a shallow easing cycle. But when I look at my inflation forecast for FY25, we are actually 20 basis points below than what RBI is forecasting of 4.5. So I would say in that sense, if monsoons turn out to be good, we do see slowdown in the food inflationary pressures because 22% of the CPI basket is directly indirectly impacted by monsoons. I would say there is definitely an increased probability of a rate cut to happen in the December policy. Considering the liquidity in the system is already into surplus, the stance could actually be changed sooner than later. Whether they do it in the October policy or they do it directly, whenever they are changing the policy rate along with, changing the policy stance, that is something which RBI will need to decide depending upon the incoming data. So we have a 50 basis point rate cut, mostly fair, but could be preponed to December, but definitely not expecting in the October policy at the moment.
Okay. Jaideep, same question to you before we wrap up the coverage. When do you expect the big cut to come in?
From a banking standpoint, I would prefer a change in stance and easy liquidity for a while before we do a rate cut. I think the last thing that banks would want is a rate cut with tight liquidity situation. Hopefully that doesn't happen. And I think given what I'm hearing, and I would agree with Tanvi, I think the earliest would be December. I think the RBI is in no mood to kind of take it easy till the time they feel that things are really, really under control. So yeah, I guess I'm hoping that of a change in stance in October. and a rate cut in either December or February.
Wow, okay. So we have got October, December and February as well. So all three on the table. Let's see if a change of stance happens before that or no. But all of you, thank you so much for taking the time out and joining us for the perspective. Look forward to talking to you in the next policies as well.
Right.
Thank you.
Just a quick one before we wrap this edition, a check on how the markets have been doing. We've sort of ignored them in the last few minutes while we were too busy tracking the policy. The Nifty is down and out, exactly what we were expecting in terms of the handover we got from world markets. A little bit of reaction post the policy. It's at the day's low point as we see it, 24,150, down 150 points on the index, 0.6% lower. The breadth of the market's relatively weak. The bias very clearly on the sell side. You've got a handful of stocks that are looking okay. Interestingly, HDFC Bank is one of those top gainers, the only banking name in the green as we see it. Apart from that, on the sell side, OMCs, tech, anything that's global facing is seeing some weakness in the session. On the broader markets, the Nifty 500 is also down 0.4%. Amongst your big loser is a bunch of stocks that are reacting to earnings. So Balaji, Amines, Lemon Tree, Maharashtra Seamless, Godrej Consumer are down and out, while stocks like BSC and DCM Shriram are gaining significantly. Well, that's
just adding Paytm, just for a second, because remember the UPI transaction limit has gone up for taxes only, I'm told, but from 1 lakh to 5 lakh. Is that a precursor for UPI payment gateways? Just the intraday Paytm chart, as that conversation was happening, has spiked up. So that's at least one clear policy impact that we can see.